Well, it's been a tumultuous 2022. Probably the best way to coin this has been pretty resilient growth across the world. But at the same time, we've seen multi-decade highs in inflation. We've seen central banks obviously aggressively raise rates. We've seen real rates moving up sharply from deeply negative to very positive indeed. And that cost of capital is manifested in big volatility playing through in FX markets, in rates and bonds as well. But we look forward as market participants. And I'm going to bring Blake Morrow into the picture because I want to explore what 2023 could hold. We want to look through our crystal ball and understand the potential big macro trends that could really change sustained volatility in financial markets. And when we understand those, we can look at the trigger points. And when we know the trigger points, we know when to express the trade. So I think this is a really important episode. Blake and I want to get together today and really look and have an open discussion, an open conversation about how we're seeing the world. This is unscripted. It's all really coming from what's inside our head, what we've been talking to clients about. So I hope it's a bit of fun, but I hope it gives some good insights about how we're seeing 2023 and the landmarks that are going to be effectively shaping your trading through that year as well. That's the situation we're looking at. It's the trade-off. Well, hi there, my name's Chris Weston. I'm head of research here at Pepperstone. In 2 seconds, I'm going to be joined by Blake Morrow from Forex Analytics. And, we're going to have a special show today. We've released the trade-off for the week yesterday, but we're now looking ahead into 2023. And we thought we'd have a bit of fun, as I said in the synopsis there. So I'm going to bring the great man into the show. Mr. Blake Morrow, how are you today?
I'm doing great, Chris. Thanks for having me, as always.
Well, I think a bit of a caveat. Look, we are short-term market traders. It's not our job to predict what's going to happen by the end of the year, so we can effectively give people forecasts or other equity analysts or rates analysts so they can use these in their sort of assumptions to make sort of expected returns. We don't care about it and that sort of stuff. For me, and I know you probably share something similar, I'll get your thoughts, it's more about let's identify the big ticket items that could really become a prevalent issue and not going to be one-night affairs. And then when we know the trigger points, we know that what markets to trade, how to trade them, what sort of direction, and how to react to these themes. Because when they're triggered, generally speaking, they can cause sustained trends in markets. I think that probably is a better way to approach a 2023 outlook. How do you feel about that?
I feel strongly about that, Chris, and I think you're exactly right. Because as traders, we are here to react to developments as they come. I always try to take it like as a trade, individual trades. I try to plan my trade and then trade my plan. Yeah. And if you are better prepared by understanding what are the potential landmines, what are the potential risks, and how would you react in certain situations, that's important. Now, obviously, things change throughout the course of the year, and we're thrown all these different puzzle pieces as we're putting the puzzle together every single day. We're throwing a bunch of different pieces every single day and every single week and every single month. But knowing how we would form those to really express that trade and know it ahead of time, that's what today is all about.
That's right. Okay, so what I thought would be good is I've looked at 4 major thematics that I think are going to be really prevalent in 2023. I know you share them as well. So let's go through those and break them down and look at the trades that could come out, the trigger points. And I think for me, arguably the number one situation is this idea that high inflation, which has been the major talking point, obviously the big factor in 2022, is going to dissipate. Certainly the consensus is that we're going to see inflation roll over and gradually roll towards target. And that's going to be replaced by slower growth across the G7 region, across the developed markets. And that could ultimately manifest into a recession, which is going to be a prevalent theme. So I think that's probably the talking point. Reduce concerns around inflation, an end to tightening, but growth concerns are ultimately going to win over. So that's the first talking point that we want to look at on the session as we're looking at. So I think when we're looking at this point, let's talk about this idea of recession. First of all, I just want to touch on this idea, this consensus view. And if I have a look at inflation swaps, which are tradable products, you can see by the end of the next year that the markets are expecting US CPI to drop to about 2.3%. Is that right? Is that wrong? I mean, for me, if I look at some of the factors that play into this, if you have a look at M2 money supply, which tends to lead US inflation by about 16 months, that's down about just over 1% at the moment. You can have a look at goods, the price of goods and the cost of goods. They've been coming down pretty sharply. You can have a look at a lot of other factors like supply chain indices, they've been coming down pretty sharply. We know that there's been a couple of months in US CPI and global CPI which have come down a bit, but certainly some of the forward-leading indicators are giving us off that situation. I mean, this idea that inflation is going to fall to target, how much do you buy into that idea? How much conviction do you have on that call?
Well, I think a lot of it depends on China. And I think the market's bought on the idea that China is going to reopen. And we're going to talk about that too, obviously, and more in depth. But a lot of it does rely on China because they are a source of disinflationary pressures for the entire world. But I'm not a big, I still see the U.S. labor market is really strong right now. And that is a source, it's going to be a thorn in the Federal Reserve's side, I think, going into 2023. Now, how it factors in globally is to be seen, but I don't know, Chris. Because if we go into recession, this is where it gets a little bit tricky. If we go into recession, are central banks going to be able to respond? And I know we're going to talk about that as well here in just a second. But I'm not as confident as the market seems to be that inflation is going to come down. How about you?
I'm pretty confident on it, to be honest. But you know what? If we don't see those signs of inflation going down to that, it reinforces the idea that central banks are going to hold those rates higher for longer, and they're probably this idea of rate cuts that are manifested in markets. People will review those positions. But we take it at face value, and the market at the moment is telling me as a guide. I don't predict where inflation is going to be. I don't have the models to do so. But the market is telling me that right now that inflation is going to be less of a concern. So I'll go along with that. What is a bit interesting thing here is if you have a look at the Fed meeting, they've coined growth for next year at 0.5%. The ECB did something similar as well. Now, that doesn't give them a lot of wriggle room. If you look at the savings rates in the US, they've come right down. Last year we had $2 trillion of savings from US consumers. By the end of next year, that's going to be close to zero. With the cost of capital going up, with credit obviously being so concerned, and with central banks continuing to fight inflation as their mandate, a recession is something that could be very feasible here. If you look at yield curves, they're predicting that. If you have a look at what's priced into rates, they're predicting that. So how do we trade a recession? And I think the first quarter and the second quarter of next year, we are going to see something similar to a rerun of 2018. If we see those economics really deteriorating, I think earnings are too high. My personal view, Blake, is that the S&P, the NASDAQ are going to get hit pretty hard on that. The dollar's going to rally. Gold's probably going to rally pretty sharply, but we'll have to see what happens with yields. And the yen will probably do quite well, and the Swiss franc will do quite well. I think the first couple of quarters could be pretty tough if we see that economics really deteriorating, especially when central banks are not supportive. How much do you buy that? I mean, I think that a recession is going to be a concern for us to trade in the first couple of quarters, even if it doesn't come until later in the year. Obviously, the markets look forward. So the best trades for me, gold, the Japanese yen, Swiss franc, short stocks, I think they're going to be working well. How are you seeing that?
I think short stocks is going to be the best trade out there. However, the trade that I'll be really focused on, especially the first quarter, maybe the first 2 quarters, is I'm going to be looking to be long the U.S. dollar. Yeah. And I do think the dollar is going to be the ultimate hedge. It's interesting how you just said
hedge. There's nothing better than the U.S. dollar, right?
There isn't, but you did say that you think gold's going to outperform, or it's going to be a good performer, and that would be a departure from what we've seen in 2022.
I say that because if we do see equities draw down, and it's because of growth concerns, and we see rates being priced out, you're going to see yields come down as well. Now, people go into the US dollar because of that safe haven quality, which is probably, I think the yen will do very nicely, and I think the Swiss franc will do better. But the US dollar will work against, certainly the high beta currencies like the Aussie and the Kiwi. But what you're going to see there is you're going to see the US Treasuries working well. It didn't work well as a defensive asset in 2022 because rates were going up. But in a global growth concern world, a recession world, Treasuries will work well, I think, in that situation. We'll see steepeners playing through. The dollar will work well selectively. But it's a different dynamic than what we saw in 2022. So I think the gold price rallies, but probably, you want to buy it in the Aussie dollar terms.
Wow. That's a hell of a trade. Now, one of the things that I know time's almost up here, but are we going to be going through recession all of 2023? No, what do you think?
Well, that's where the pivot comes in. So we are out of time, you're right. But one of the most important points is if you look at the vision shared by what's in the rates market, do we get a rerun of 2018? Pull up a chart of that. We saw markets in a similar situation. Real rates were moving sharply higher at the start of the year into 2018. Markets were predicting that we were going to see a pivot from central banks. We got it. Yeah, is that a case study that we need to look at for 2023? I think it's a very good chance that we're going to see that. So we could see deteriorating economics, financial conditions tighten sufficiently. And then, at some stage, probably into Q2, Q3, central banks start recognising that. The market front runs that. We start seeing the pivot being priced in. And we could get growth assets working very well. So I think that's where we need to be very lively indeed. Anyway, so I think that gives us a really good talking point into the central bank situation there. I want to talk about that idea, that pivot. And it sort of really feeds nicely into what I've just been talking about there, Blake, because go into the rates market, euro, dollar, SOFR, Fed funds, they're all predicting big rate cuts going from the second half of next year. So, from June of next year through to the end of next year, we're pricing in about 56 basis points of cuts. And what I think is really interesting, Blake, is that they're saying that inflation is actually going to be higher than lower than the Fed funds rate by March of next year. The central banks have made it very clear they want to have the Fed funds rate above the level of anticipated inflation by March, or by a certain point. That's going to be the trigger point. The market's betting that's going to be March. Seems a bit punchy to me, but that's where we are. We've got the markets predicting one thing. Central banks are saying, no, the battle's not won. We're going to still keep rates higher for longer. And economists are also doing something similar. So we've got this big trade-off at the moment between what the markets are seeing and what central banks are seeing. It's very similar to 2018, as I say. Who's right, who's wrong? Question.
Well, I had this conversation. I was having a conversation today with an ex-hedge fund manager who does think that the Fed is actually done hiking rates as of right now. This is it.
Wow.
That was it. And he says that the market's gonna push the Fed and other central banks into actually cutting rates into next year. I have a hard time believing that. If I'm right, and I think inflation is going to be a little bit more sticky, then I have a hard time seeing the central banks cutting rates, and I think the Fed's going to actually push us into a little bit deeper recession as a result of that. But I think pricing in rate cuts is a little aggressive at this point, Chris.
I think it's a hedge against recession, right? So I think that we do see deteriorating data. The thing is that we're going to get a 25 basis point hike or 50 basis point hike in the next meeting from the Fed in February. And what's going to change the outlook? Powell basically told us he is going to be raising rates again. But what's going to change us in that time? Now, financial conditions can tighten very, very sharply, and that may change things. But, look, we've got the next payrolls number coming on the 7th of January. It's going to be a strong one. I see no reason why we're going to see a massive deterioration there. Wages are still going to be very, very high. And that's not going to change things. That's not going to stop rate hikes coming through. The next CPI number, that could fall. But again, it's still an absolute level that the Fed will still want to say we want to put the wind to our backs. And that means a 25 basis point hike in February is still but assured, to my opinion. Do we get 50 or 25? But they'll hike again then, because the data's not going to be sufficiently weak at that point. It's when we start going into sort of the latter stages of Q1, which I think you're going to start seeing initial jobless gains start moving higher. You're going to start seeing the unemployment rate move a little bit higher, depending on what happens in the participation rate. And that's where the market could say it's on. We're going to get Q1 earnings coming through, and that could show net interest margins coming under pressure because goods are coming down, the cost of labour is going up. And that's where the stock market really looks at this and says, net interest margins are a problem for these banks, for margins for companies are going down. And that's where we could see a big re-rating, and I think stocks coming down. So I think that's an interesting one. The other big unknown, Blake, quantitative tightening. This idea that central banks now are running down the assets on their balance sheet, liquidity's coming out. We're seeing that reserves are falling. The ECB just opened the door, saying that they're going to do passive QT at 15 billion euro rate from March. They were pretty explicit about that. The market, probably thought that was more explicit than they were talking about. The Bank of England are obviously doing that for not just through passive, but actually from forced asset sales as well. The Fed are doing it 95 billion a month. That's not going to change. That's the biggest we've ever seen. You can look at balance sheets are contracting and effectively risk assets are pretty close to that as well. So how much are you looking at that and saying that there could be a turn? How much are you looking at the repo market? How much are you seeing that QT could be the big unknown for 2023?
Well, QT is the big unknown, and that's just tightening financial conditions will continue. And I think that's like the biggest thing that's going to be the first half of the year probably, biggest weight on the markets. But then I have to ask you, Chris, if the Fed and other central banks decide that they have to cut rates, does that provoke a turn in asset prices higher?
It's a great point. But first of all, just a great point. If the Fed are cutting rates, if they signal they're cutting rates, then QT's over, right? They can't be. I know they've separated the two, but you can't be looking to cut rates and continue with QT. It's just not going to happen.
Right.
But I still think that at the end of the day, that the bar for cutting rates is so high at the moment, but the market may get that depending on what happens. It's data. It's a data dependent. I've very quickly got to get this in. The Bank of Japan, for me, arguably one of the central banks you've got to be watching. Kuroda comes out April, though we know in March. We know they've got a review on your YCC policy. If they take that upper band on YCC up to 50 basis points, it could. People are saying that Japanese pension funds. They could repatriate a significant amount of money back from overseas markets as the net supplier of capital back to Japan, cause massive inflows there, cause yields to spike up. It could be a massive event there. So how much are you watching the Bank of Japan policy very quickly there?
I want to be a buyer of yen next year, and I don't want to overshadow anything that you're going to say for 2023.
No, I think the yen's the place to be. Yen and Swiss franc to me, especially in the first half. If you don't like bonds, if you like bonds, if bond yields are going down, and I think they did peak in 4.33 on the 10-year. Then I back in October time. I think the yen's the place to be, and I think when they do that review, there's going to be some big vol in the Japanese yen. So definitely one to watch. One of the other areas that we need to look at is China, and we talk about the elephant in the room. Now we've just seen. We're waiting for the two sessions meeting that comes out in late March, and they'll detail the personnel that they're going to have to attack the economy and grow the economy. We know that economic growth is still their priority at the moment. We'll get their GDP forecast. We expect them to still target 5.5%, so somewhere around 5.5%. That's sort of in line with the consensus. The consensus growth for next year in China is about 4.8%. We talk about these tales of two halves. I mean, we're probably going to see a weak first half, reopens after that two sessions, and then we see good growth coming through as a lot of those savings are drawn down and some of the demand kicks in. But Chinese assets have worked well. We've seen big vol coming through in dollar CNH this year. But we talk about weak global growth scenario there, Blake, with the idea that we could see recession. So we're going to see a US-Chinese recession. So we're going to see a recession in the UK, one in Europe, probably, maybe one in the US. It's looking likely to me. But China's going to be such a big part of this global growth story, the emerging market story. Everyone's very bullish on emerging markets for 2023. How do you see China? Are you bullish on China? Do you think we're going to get this tale of two halves? And how do you trade it?
I am bullish on China, and I think if I had the ability as a North American trader, I don't, but selling the US dollar CNH as a retail trader would probably be the way to go in that trade, or better yet, playing copper to the long side. Yeah. The break above the 200-day moving average. Yeah. That whole trade is, I think, the way to go. Yeah. But the US dollar CNH is an interesting vehicle, and I think it's one that we have to watch because it's one of the levers that China has, right? Being that it's a managed float, and I think the boom bust bull bear line is around 7. We trade below that right now, going into 2023, and I think if it continues to come down, that's a very, very bullish China, a bearish China event, meaning that a bearish global event is what I meant to say, is if the US dollar CNH continues to come down.
I think,
but if it reverses,
go on, sorry,
no, I was going to say if it reverses higher, I think that's going to be one of the tailwinds for China.
Yeah, so. It's an interesting one because I think going back to a point of recessions and central banks. For me, we talk about these trigger points, and everyone's been talking about recession in the US for ages. Like when it's going to happen, it's been one of the most talked about events that no one seems to be overly prepared for. But for me, the yield curve is really important in that. And when we start seeing a steepener, so you see long end yields moving up more aggressively than front end, is driven by rate cuts being priced in the front end. That to me is going to be the trigger point. When it comes, we don't know, but when that to me is the trigger point when you're going to start seeing dollar weaken, you're going to start seeing risk on big time. Equities move up. Banks absolutely love that. And that's going to be my trigger point that I'm looking at to give the point that, rate cuts coming in the market. We're seeing that in the 2-year. Going back to the China situation, though, China's actually something that we've been trading already. Chinese equity markets have already responded. We've seen some support in copper, certainly relative to what we've been seeing in crude. But what are the trigger points that now we go into the new year knowing that so much has already been priced into this story that's that's already there? Is there going to be new news you're going to be looking for? Is there going to be new levels? Personally, I'll give you an idea. I'm looking at crude. I think when crude starts moving up, I think that could be a real sign that it's kicking in. People are less concerned about OPEC meeting, what's happening in SPRs. But I think crude could be a really interesting trigger point. So is there anything, knowing this is an old trade, that you suspect could be a signal that how do we trade China, knowing that's already quite low in the price?
Yeah, again, I think the play is just copper is like the play that I would, me personally, that's what I'm going to be looking for. But you bring up an interesting point regarding crude, because crude is at a juncture, which I've seen it at multiple times in the global economy, where it becomes more constrictive to growth. And I think we're not far from those levels. I think somewhere around the $80 to $90 level, it starts to have a negative impact on global spending, and people start thinking about it from an inflation standpoint. So it'll be really interesting to watch to see if crude rallies and to see how the rest of the market responds to that. But I think that's a good clue to how China's doing as well.
But what happens? Okay, look at this one though. This is an interesting trade. Long China, long Hong Kong, short Nasdaq, short S&P. Now we've already known that's been working very well. It's one of my plays of the day on the normal trade-off for a while. But if we are going to see economics deteriorate, central banks still not supporting markets in that, we do get this drawdown coming through, but China's still supportive. One of the best plays for me is this idea of being long Chinese equities, the CN50, the H shares, and short US 500 or short Nasdaq as a pairs trade, and trying to ride out that outperformance, because we know that China's going to be throwing liquidity at the situation. They're going to be looking to support economics into the two sessions. So I think there's a really interesting trade there. It's already been working. Is there more juice in it? I suspect if we get the drawdown in US markets, that trade continues to work well.
Well, there's been so many outflows in China over the last how many decades now? I mean, so I think that's a natural trade that pairs trade is probably the better China play that I could think of.
Yeah.
So,
well, I think there's going to be money flowing. I mean, global equities have been outperforming in their local currencies relative to US all year, really. So it's been an interesting one. I want to touch on another factor that we're looking at, and that's the idea of geopolitics. Obviously, geopolitics was a massive part of 2022. As I said, great for volatility, bad for humanity. It's certainly been very bad for Ukraine, bad for Russia. There's other factors that have been playing through. As we look into 2023, though, we've got China, Taiwan on the docket there. Something people have been looking at from time to time in 2022. Does that become more of an issue? We look at we look at China. We look at Russia, Ukraine. The possibility of a ceasefire, or do we see actually it materialising, getting worse in the short term before it gets better? I think that's a real possibility. We're looking at Europe's relationship with Russia, the US's relationship with China. We've got the debt ceiling as a sort of political event that potentially kicks in later next year. For me, this is outside of my pay grade. I'm really sort of just relying on market pricing to tell me when this becomes a market thematic. But what are you specifically looking at here, Blake?
Well, let's start with Russia, Ukraine, and let's try to be optimists here. Let's imagine that the tensions ease. What's the trade there? Because I mean, everybody's going to go, well, I want to buy equities, right? I think that equities they're suppressed. You're going to see a rally in equities, but is that really the good trade?
Well, it is. It definitely
commodities?
Is. Yeah, commodities are the natural one, right? So the natural, you're going to see, wheat under pressure. You're going to see European nat gas prices under pressure. You're going to see Brent prices coming a little bit lower, although it's already had a bit of a drop, but not on this thematic. I don't necessarily think a lot of market participants are priced in the ceasefire. I don't think it's going to happen myself, and I'm sure there's people who are watching this who say that you're wrong. You don't really know what you're talking about, and I'm happy to take that on board. But commodities have got big downside risks if we were suddenly to wake up and see headlines that Russia and the Ukraine are at the at the table, potentially negotiating a ceasefire, I think you're going to see some big downside in energy and some of those agricultural commodities for sure. But I think at the same time, on a more positive note, people would say, look, if we're going to get that, then there's going to be deflationary for Europe. Some of these rate hikes are going to be priced out, and I think you're going to see massive outperformance from European equities. I think they would absolutely go for it. I think you'd see a lot of capital flowing into those rooms because big risk is going through. For me, I think that there's a high risk that actually this gets worse before it gets better. I just don't think either side are prepared to negotiate. But at the same time, I'm not an expert in these fields, and if we were to wake up, I know what to trade. I have these ideas about how markets are going to trade, and that to me is more important than actually being able to prophesize and be a military expert in this situation. So I have these kind of scenarios in my head, but if we were to see some very constructive signs that they're prepared to get to the table and talk about a ceasefire, then commodities, we'd look at which ones we're going to trade. Palladium, wheat, natural gas. How's that going to feed into it? We're going to see inflation expectations falling lower. Rate hikes are going to be priced out because we're going to see inflation expectations roll over, and equities are going to love it, aren't they? So I mean that's the scenario I'm looking at. So what else have you got to add on that?
How about China invades Russia? What do you do?
China invades.
I'm sorry, China invades Taiwan. Did I say China invades Russia? It's late in the day for me, Chris. Bear with me. China invades Taiwan. What do we do?
I don't think that's a story for now. But I think the headlines would roll in, and the markets would get very nervous before that happens. But if we were to see the market, and I'm talking about the market, ramp up its conviction that is a major thematic, and we have no idea if it's going to happen or it's not. We just.
Sure.
Look, the question we've got to ask, Blake, and ask you, is it a one-night affair or has this got legs? For me, it's got a sustained move. If we see the market going, we've just taken up our conviction of this happening from here to here, is it a one-night affair? I don't think so.
No. And if you thought commodities moved aggressively on Russia, Ukraine, imagine what they would do under that situation.
Yeah.
You would have commodities going bonkers, and there would be major selling pressure in the equities. So I think that's something, I think that is a real risk. Look, if you're a believer that China is going to take advantage of the Biden administration while he's in office, maybe 2023 is your year. I hope.
And you put Korean won on the table. You put the Kospi on the table. You put the Korean and Taiwanese tech stops firmly on the radar. I think they're going to be moving very aggressively. They'll tell you when they think that it's a market thematic. For me it's about let the market tell you when they think this is a proper thematic playing through. Rather than necessarily say, this is in the news. If the market doesn't respond and it's front page of the FT or Bloomberg, the market's not too concerned about that. To me, is a better guide. But absolutely, in that scenario, we just go short risk in every size. Short tech, long commodities, long the dollar, and short the Korean won. I think is probably going to be the trades there, but it's not going to be a one-night affair. And you just recognise the signs, look at the trigger point, let the market tell you when the right times and force you into a trade. Anyway, I think it's really interesting. I think some big thematics that we've talked about there. Blake, I really want to sort of delve into how you're playing it. What are your picks and your sort of trades for the year? So let's go into plays for the year. I thought this would be an interesting one. Look, Blake, we're not going to hold positions for a year. We're not going to do that. If we're not sell-side banks, we don't come out and say, we think the dollar's going to go down 5% for the year, or we think the S&P is going to be at 3,500 by the year end. I mean, for me, that's not what trading's about in any capacity. And in fact, it just makes you fall in love with a view, which is to your detriment. But for me, let's go into to what I'm looking at now. I'm not going to say one specific asset. I'm going to go with this idea that I think we're seeing a rerun of 2018. And my first point is that I want to be a ninja. Okay, so what do I want? What do I mean by be a ninja? I mean, I want to trade with stealth. I want to trade with a certain nimbleness. And I've got this view in my head, which I've said that I think that we're setting up for 2018. Real rates are pushing higher. We've got deteriorating growth prospects. We've got central banks that are looking at inflation and just going after inflation, that are not prepared to support the markets. The markets are seeing a vision that's not being shared by that. We could get drawdown. And as that deterioration in in data comes through, I think we're going to see a drawdown. I think the dollar's going to rally. I think equity markets go down. I think vols go up across asset class. And I think gold will do pretty well in that situation as a recession hedge, and real rates probably moving a little bit lower. We talked about that. So I think, in that environment, I think my picks would probably be gold. I think gold's going to be a really good place to be. The market's already shown you they like that. In FX markets, I like the Swiss franc. Who doesn't like an 8% current account surplus when global growth is deteriorating? This idea that you've been repatriating savings all around the world, you're bringing them back. The Swiss franc suddenly works much better than it did in 2022. As a safe haven. The Japanese yen's another place. We've already seen signs that as bond yields are falling under growth concerns, that the Japanese yen is working well, and that's actually reverted back to its safe haven qualities, which it lost, of course, when bond yields were moving up and people were, looking at putting carry on. But I think the Swiss franc and the Japanese yen would be my pick, and then the US dollar will probably work selectively against the high beta FX, Aussie, Kiwi, and maybe the pound as well in that situation. But I think that we will get the pivot. Now, a lot of people would disagree with me, and that's fine. But when we do get that pivot, and I think when does it come? I don't know. Predicting that pivot is a fool's game. I don't. But when we do get that V-shaped bottom, or we do see those flows changing, then I've got my vision on how that's. I want to be long the Aussie dollar. I want to be growth. I want to be Nasdaq. I want to look at all these factors that play well in a market where a lot of this cash on the sideline comes in. So my idea is trade like a ninja. If markets are deteriorating on that vision, I know what to trade. I know the markets that I think are going to benefit the most and how I can generate alpha in that situation. But when we get the turn, and I think we will get the turn, how do we recognise that turn? What to trade in that? So that's my view. Trade like a ninja. Trade with some stealth. Be nimble.
All right. Well, my view is kind of like yours, Chris, in the respect that I do think that the recession is going to recession fears, and actually the length of the recession, the heaviness of the recession, if you will, is going to play heavily on equities. And I think the place that you want to be is the dollar, but I don't think the dollar is going to hit a new high. I think the dollar is in process of carving out a longer term high. So I actually want to sell dollars as we get into probably your pivot, wherever your pivot is, Chris. Once the market sees the light, and that's where you want to sell dollars, but I want to buy emerging market currencies, specifically the Mexican peso. I do believe Mexico is a big beneficiary here on this side of the world. From China, Mexico is where a lot of manufacturing is going here from North America, just all the way around. I want to be long Mexican pesos. So any rally in the dollar, I'm selling that dollar longer term. But I think the euro could actually dip towards parity again. And I think we might even trade slightly below parity. But at the same time, I do think that I will be looking to sell dollars on any significant rally this year in 2023. But I think the first half of 2023 is going to be a rough one for risk, just in general.
That's right. I think the Mexican peso is a really interesting place to be as well. I mean, if we get crude prices popping up because the China reopening trade, then the Mex is going to benefit that. You've got a sort of beneficiary because it's close to the US, and I think in that situation, it got a little bit of a safe haven thing relative to some other G10, high beta currencies. So I don't mind the Mex. And of course, they're going to continue raising rates. They've already got 10.5% interest rates there that give you that positive carry. So I don't mind the Mex. So I think that's an interesting place to be. But I think that's probably a good place to wrap it up. We've gone through a multitude of views as quickly as we can. And it's really interesting to see how people, I'm talking to, and the clients I'm talking to, and I know Blake with his Forex analytics community are talking as well about their outlooks and the trigger points for 2023. And I know you guys out there have got some very strong views. So leave them in the comments. I'd love to see what you have. And I'm on to the UK, so I'm going to be taking some well-off breaks. But I want to see I want to read this on the plane and see what you guys are doing as well. So leave us a comment about how you're trading the market, your vision and views for 2023. And to all our regular viewers for the trade-off, we really appreciate everything that's going on this year. We've built a good community, some really good regularity comments coming through, and we'll be back more for next year in what we hope will be a huge year for financial markets. So we'll see you then.